So I think it's interesting that, as a former venture capitalist and now managing editor at TechCrunch, I never heard anyone talk about financial planning and analysis. And then the last couple of weeks, everything suddenly changed. Like suddenly people are counting dollars and cents. People are starting to track where their money's going. As we heard in the last demo, FP&A sorts of writes the past or interprets the past and writes a vision for the future, which I thought was very novelistic. The goal of the discussion today, I'll introduce our guests here in a second, is to both talk about what is FP&A, what are sort of the logistics processes that go into the job, and then to talk a little bit about what do the changing dynamics of SaaS metrics look like for 2020, which I think is actually a really interesting conversation at the end of the year here. So I'm going to start right on my left with Peter. Why don't you introduce yourself?
Hi.
Hello?
There we go. Peter Iorio, I'm the Director of Finance at Electric AI. I guess we're going to use the AI right now. We're a Series B company. We are a remote IT support solution for typically SMBs here in New York and 9 other markets.
Hi, I'm Sarah Alper. I'm the VP of FP&A at UiPath. I've been there about a year, coming up in a week, so an anniversary. Yeah. Vesting? No, just kidding. No, so UiPath is a robotic process automation company, which is basically, software bots sitting, on your computer, running mundane, repetitive tasks for you so you can do more creative, exciting work.
Hello, Scott Buxton. I'm the VP of Finance here at Datadog. Been with the company for about 4 years. We just completed our IPO on September 19th. Thank you. For those that don't know us, we are a infrastructure monitoring solution, mainly for cloud environments, but host monitoring, APM, logs, and we are also hiring. So we've got Allie in the back. Sorry, shameless plug here. She's standing wearing the Datadog t-shirt. We're hiring for operational accounting, FP&A, so she would love to meet you. Thank you.
And before we get started, I'd love to hear from the audience real quick. So raise your hand. I'm going to ask 4 different sizes of companies. Whatever your employer or you're founder of, I'd love to get a sense of the size of the companies you're all coming from, just so we got a sense for the audience here. How many of you are in companies that are 0 to 10 people? Raise your hand. So a pretty good chunk. What about 10 to 50, kind of medium-sized companies? And then 50 and above? About a third. So we all go different sizes. So I think one of the first questions I'd love to ask, and I guess we can start with Peter because I think you're the earliest stage company on this panel here, is what does FP&A look like for a Series B company? Like how many people are on your team?
You're looking at it.
How much infrastructure do you have? Do you have software? Are you on Excel?
Yeah. Yeah, you are in fact looking at FP&A for an early stage company. So with that, it's what are the tools and what are the processes that you can put in place that'll help you keep your sanity and help you get your job done. I'm going to make a plug. I'm sorry, I have to, but I actually do leverage Cube in my most recent round of budgeting and planning. So we recently came off of our 2020 planning. Let's call it our first phase, first cycle. We just presented to the board our first pass at 2020. I would never have been able to do it without a tool that allowed me to consolidate 15 different department level income statements, P&Ls with bottoms up drivers. Without a tool like that at my disposal as a one-man team, if you were to take a step back a year before, you really just have to leverage spreadsheets and sort of hammer through the problem. And when you're talking Series A, getting ready for diligence, and Series B, it's really about trying to get all the key stakeholders in a room to get through as many of the meaty items that you can tackle as possible.
And I don't know, over to you, Sarah. I know you have a Big Four accounting background, worked for a long time, and the tech side of a lot of big companies. What was it like to move from that world into UiPath?
Yeah, I mean, I came from GE for 11 years and a number of other bigger companies. You have a lot of systems, a lot of processes, a lot of people. lots of spreadsheets and lots of different, stakeholders. In UiPath, it's a little simpler from, a system ecosystem perspective. We have one ERP. We definitely are living a little bit in Excel and spreadsheets. We are going, we're live with a planning platform, Adaptive, which is attached to our ERP. We're in one CRM. We've changed to, a big HRIS system this year. So we've had a lot of infrastructure, built over the past year, or, really implemented and live in the past year. So that's helped because we're in one sort of single ecosystem. And then from a people perspective, it's definitely slimmer, but I think that's sometimes easier because you can just kind of manage what you need to do and not create work that doesn't need to be done. And yeah, so I mean, for me, it's the challenging part for FP&A and sort of where I am a Series D company that is, thankfully very hyper organic growth. The challenges are really just keeping up with the growth and understanding and how to forecast that, and still live in manual processes from a finance perspective. In some cases where you need to get bills out, and you're onboarding tons of customers every quarter. So, the challenges are more kind of on the accounting and finance side, I would say. But yeah, it's a slightly different sort of, the hyper growth for me is different than like a GE, which I would say was a little slower growth and easier to plan. Here I'm wrong all the time, but in a good way, so that's good.
And Scott, finally, I mean, you went from being a privately held company, now you're on the public markets. What was it like to move your systems in the FP&A kind of infrastructure from what you required a couple of years ago when you first started to what you have today on the public markets?
Yeah, absolutely. So when I joined Datadog, we were about 100 people, approximately $25 million in ARR. Our CEO, co-founder, my boss at the time, was running our financial model. And so, when I started, it was really, I guess, first taking that over from him and then giving the various departments within the company insight into what their budget is, what actuals are, not really even holding them accountable for that because, similar to Sarah, we have always been hyper growth. So how do you really compare, a budget to an actual? It's going to be off wildly every single time. So that was really kind of the first step. A few months in, hired an FP&A manager who had banking background as well as startup experience. And she's now our director, because if you fast forward to today, being public, we actually run 3 financial models. We run our internal board model, which obviously we present actuals to the board of directors at every meeting. We also run our aggressive management model, which what the company feels like is kind of our stretch goal. And then we have our street model, which is what we obviously publish to Wall Street. And we have a team that's running that of 5 people. So looking back, to 4 years ago, where it was just our CEO, co-founder, that's come a long way to now. And I think, I honestly wish we had a system that we were using, potentially Cubed or one of these other ones, but we are in Excel. We're approaching 500 million in ARR, and we're 100% in Excel, 1,400 headcount. Again, it's not ideal, but it is a choice company-wide, the flexibility that provides. Of course, that comes with negatives, right? You have the version control issues, spreadsheet errors, as being an issue. But it's worked out well so far.
That's great. And opening up to the whole panel here, I'd love to get a sense of cadence. We'd often talk about annual budgeting, 2020 budgeting, 2019 budgeting or whatever. But in reality, startups change a lot month to month, sometimes week to week, depending on where you are. So how do you think about the timing of a lot of the forecasting models? I mean, are you updating literally annually in November and December for next year, or are you thinking about it week to week or something in between?
Yeah, so at UiPath, we start budgeting in, I'd say, August. We sort of set the timelines and start the kickoffs for early September, and we basically spend, September through December finalizing it. We present our board, operating plan in January, so we want to get through everything before the holidays, plus fourth quarter close. So that's just the general planning for the next year. And then from a forecasting perspective, we look at a certain number of metrics and KPIs every week that we share with the leadership team in a operating committee internally. And we close the books monthly, and we present results to the board monthly. And then we forecast every quarter. So we forecast forward for the year every quarter.
Got it.
And then even now, because of the growth and cash flow and things like that, we're really forecasting forward the next four quarters at least. So we have a lot of seasonality in some of our quarters, and from a cash flow perspective, that's important to kind of have a foresight too.
So, like I said earlier, we just finished our first pass at budget for 2020, which started probably about 3 months ago. It's been that long of a process, yes. And it'll probably finalize after the year end with actuals, things of that nature. So by February of next year, you'll have a complete 2020 budget. In terms of forecasting on an ongoing basis, so that becomes the budget, right? One version for me right now. In terms of forecasting, my philosophy is I try to maintain some concept of a rolling forecast that gives me an idea on specifically cash as time goes on, since cash is king and the thing that everyone cares about, right? Early stage companies. We monitor that on a weekly basis. This typically has to do mostly with headcount ins and outs or any other large expenditures. And in terms of actually setting some sort of a cadence for like a hard reforecast or a point in time, it would be once a year, mid-year with the board.
Got it. Do you have anything on that, or do you want to go?
I mean, yeah, just to reiterate, a rolling forecast, I think, is the way to go. We're very similar. We have our board meeting coming up December 12th. We're a calendar year, fiscal year end. That's going to set the 2020 plan. Obviously, we're going to have to present to the street every quarter what the new quarterly guidance is, as well as full year. But prior to going public, we would set that annual fiscal year budget that would drive, C-suite compensation based off of ARR targets. That wouldn't change, but then we would also present this rolling forecast that would be, driven by headcount additions, anything that happened with cash, or top line to have a real kind of running model.
But I want to pivot a little bit into the metrics. I know that's the big subject for this conversation. So obviously there's been a lot of attention on SaaS metrics. A lot of SaaS companies have gone public, including you guys. How has the metrics that investors, VCs, managers look at changed over the last couple of years? I mean, are you noticing any patterns? Are people more focused on cash than they used to be, or cash flow? Are they more focused on net dollar retention rates, or any other metrics that come to mind?
Yeah, I guess just to start real quick. So our board was always focused on what is top line and what's the cash in the bank. And so what it actually meant for the rest of our team, especially the accounting side, was they didn't really need to see a P&L or a balance sheet because you knew those metrics pretty much, day one. They would then focus later on CAC payback, gross margins, things of those nature, the net and gross retention. But that would always come after the fact. The two metrics they always wanted was top line and cash in the bank. I mean, I think the one thing we've realized going public is other metrics that investors, sell-side analysts focus on. Billings is a huge thing to try to gauge seasonality within a business, and that's something that we never ran the business off of. There's this concept of RPOs, remaining performance obligations, right, which most people don't even know what that acronym stands for. And that is a huge focus from sell-side analysts because they want to know, what is your dollar metric around that is from an obligation standpoint. So I still think from a core perspective, it's the same kind of metrics, but slight variations of them.
Yeah, at UiPath, I would say we're very much focused on growth and profitability and the balance between the two. So from a growth perspective, it is bookings or billings, over year-over-year growth, revenue growth, ARR growth. We're about, we're over 300 million in ARR, and we have over 3,000 employees, and we were born global, is what, our CEO says, and it's true. So we've got people in over 30 countries, and so we have a big expense base as well. So when we look at cash flow, that's very important. And same thing for us. We're not necessarily producing like a full P&L. We're producing the cube P&L pro forma that you saw basically for our board, and cash and is king as far as what we look at as well. I would say as we've gone through a Series D, I learned a lot through that experience, and the investors are definitely looking at our expansion rates and what's the lifetime value potential for our customers. I think of that a bit as sort of a marketing metric more than anything else, but for us, we look at that, and our expansion rates are things that we look at every single month and quarter as well. But the same.
It's essentially all the same metrics. I can.
Well, we switch gears, because I know a lot of the folks in the audience are from smaller companies, and you're the smallest one on the side here. Why were you hired? Why were you the first hire? Why at that point in the company's timeline? Why? The best possible interpretation of that question.
I think at that point, So Electric, let's see, they are a Series A company. They had just finished fundraising in February. I was hired around September, towards the end of September, and their VP of Sales was running their operating model and managing QuickBooks, and so they were using an external. yeah, exactly. Anybody who works in finance,
so you're going to 20x the growth in the next quarter.
Red flag. I think at that point it was. Sorry. I think at that stage it's once you've proven your concept and you understand that the product is marketable and you're building a company, at some point you need to hire somebody with a finance and operations background, and so I became the first one, and I. At least looking back at that moment, trying to understand why me versus a controller, actually, which is a debate that I often have with early stage companies. I think that for them it was more somebody that had strategic finance background versus a pure accountant at that given point in time. But then, right after me, the very first hire was, I need a controller to work by my side, otherwise I'm never going to be successful.
And going more broad, have any of you been involved in sort of the VC fundraise process for your companies, particularly on the strategic side? Are you helping to produce the decks, the financials, helping put together that forecast, and how do you sort of work out the logistics of saying, maybe at the growth stage, different types of investors might need different types of models or feedback in that process?
Number one, we actually have a really great board and really great associates that work on our that come with our investors, so it's really easy. It's really easy to tap into them and figure out what is expected as you move along the different stages. But even for ourselves, my background is I worked for a public company, and then I dove immediately into a Series B or Series A and then B company. So the furthest I've seen is C, so I know all the way up to C, and then just a public company. So this will be interesting to see how things mature, get to D, and then maybe hopefully go IPO or some other type of event. But we've sort of, between myself and the rest of the leadership team, we know, looking at core metrics, let's say, so core KPIs, we say, okay, we know we're here, and these are the metrics that we can produce scalably, repeatably, and with a high degree of certainty as to the accuracy and validity of the numbers. As we look at other metrics that investors typically want to see, like CAC, LTV to CAC ratio, CAC payback, things like that, we know that it will come as, let's say, the company matures, more people can help build out the finance function. You have a very, very high level of or degree of certainty on your financials at that point, and no 100% GAAP compliant ASC 606. I'm gonna start throwing out crazy terms, but once you get to that stage, then you can really produce them regularly.
You either want to address that or kind of move on to another topic?
I mean, for me, the one thing, again, going through Series D for the first time, our plan for 2019, our operating plan, was very much heavily used. There were definitely a couple other ARR forecast models. We run 3 models as well that sound similar, but we're not an IPO company, but that run similar, an internal, a board, and a stretch sort of concept. So we had all those models produced, and then we're a very transparent company in general, so there's a lot of data out there on us, but we shared everything we needed to during, investor data rooms and, data science that they do. But the plan was a huge piece of the model, I would say, for 2019, and that's what we relied on a lot.
Yeah, so at Datadog, I was joining around the time of the Series D funding, December 2015, that was led by Iconic. But during my time at GitHub, when we were raising our Series B round of funding in spring of 2015, I think what really struck me was the type of presentation and how the questions would vary based on the type of investor. So Sequoia ended up leading that round, but when we were meeting with the Tiger Globals, the Dragoneers, the crossover investors that also invested in public companies, Wellingtons, there's a bunch of them out there, it was a different set of questions, right, than your traditional venture capital firm that was investing in high growth and a hot product. I think the crossover investors wanted to see a more buttoned-up model, see budget to actuals, potentially really hammer you on things, whereas a traditional VC didn't really do so.
And then one last question I know we're going to open up to the audience, and this probably goes to Scott and Sarah the most, but when you're looking at it from an international perspective, how does international play a role in forecasting and planning? I mean, is that something that you have different kind of models for each country that you're operating in? Is it one global model? How do you sort of balance that out?
I mean, for us, so we are fairly global. We have French co-founders, work out of New York City headquarters, but I think we have 9 international subsidiaries. I think what makes it easy for us is that still 100% of our revenue is booked out of the U.S. It's still all in USD. I think selfishly that makes it very easy for us. So we're just looking at cost centers when we're forecasting those international entities. So it really hasn't become that complex for us yet.
Yeah, we're not that complex either, though we are a third U.S., EMEA, APAC, I would say. And Japan is a very big market for us. So for us, I would say most everywhere except Japan, which is a very mature market for RPA, the models work very closely together, and we're all very connected. Japan sort of runs as its own P&L, and so there's a little bit more. I'm missing a call tonight, but that's okay. We meet with them weekly, and they're on the same schedule and rhythm as us, but building the processes there for their growth is something we're working on. But overall, very connected, and all USD pretty much as well from a sales perspective.
I won't cut you off, but you have international.
No comment.
All right, let's open. Yep, let's open up the floor to questions from the audience. We got one right over here. You're first.
I would like to have your perspective. One of the most painful things every year is to file taxes. So, what's your relationship like tax planning, and how do you get your tax advice?
Personal or corporate tax?
Yeah. All right, I'm going to assume corporate. Yeah, I think so. Datadog still is in a consolidated net loss position, so we're not a federal tax or state taxpayer, so it's not that difficult. From international perspective, we are cost plus structure, so our international entities do pay taxes based on that markup that we reimburse their expenses for. But we work with a Big Four firm that comes in, does our tax filings, does any state tax filings. So we're starting to think about tax planning as it relates to becoming a taxpayer, because there's a lot of complexities obviously involved with that. You have to forecast that to Wall Street and whatnot. But I think up to this point, it hasn't been that much of a challenge.
Yeah. Do you have anything?
I would say sales tax is actually worse than corporate taxes. Just a
Why is that?
plug on tax. Well, number one, especially for early stage companies, most people doing business in the U.S. oftentimes fail to remember that nexus is a real thing, and both physical and economic, and so nobody ever runs the test. People don't often do taxability studies on their product to determine whether or not it should be taxable in various states. All states have different. Forget it. Yeah, there's. Yeah, exactly. So I just actually finished a very painful process with a Big Four firm to get fully caught up with sales tax in all the markets that we do business in. So for early stage companies, don't put that on the back burner for too long.
Yeah, next question right there.
Great. Thanks for everything. With companies like Cube and UiPath that actually automate a lot of the tasks that you're overseeing now, in 5 years, do you think you'll have fewer people working for you, the same number, or more?
It's just going to be Peter forever.
Yeah, Peter forever.
The UiPath, Sarah,
Me
go.
forever.
Yeah, I don't know how to think about it yet for FP&A. In finance, I would say we would probably goal to have less people in finance, but I envision that we'll have more people in sort of an RPA COE concept that are running our bots, running our processes, and continuing to automate. And so that's how UiPath thinks about it. And that's how I would think about it. And I think that, I feel like that was probably directed at me more than anyone else anyway. I also think that, I've done FP&A for more years than I care to count, and my picture is obviously showing that. But I think that a lot of what we have done has not been the most fun and glamorous tasks and things that rack my brain every day, but I hate doing them. So I kind of welcome RPA from that perspective, and things like Cube and just automation in general, which I love, and integration and financial systems that are integrated I think are really important, just for everyone's mental sanity and for efficiency. So for me, one of the main reasons I even joined UiPath is because I do think that's the wave of the future, and I think our young generation likes touch, and they're not coming to work on spreadsheets and move data around anymore. So it's something that we all need to embrace, and I'm super happy to be there doing it.
Fantastic.
Back to the sales tax question, actually was having this conversation today because I was talking about RPA as far as populating sales tax returns that you have to do every month. And our Big Four tax advisor said that they actually worked with a very large Fortune 100 company that used RPA to reduce 1,300 man hours as it related to sales tax filings down to 30 minutes. So I think it's absolutely the wave of the future, and that probably resulted in a lot less headcount at that particular company. So I think that that's definitely where things are headed.
Amazing. More questions from the audience. You go.
How do you, when you're doing your planning, get consensus among the team and the executives for some of the tougher conversations? Go first.
Consensus from co-founders obviously is essential in a company, right? When you are coming up with a forecast for the following year. I think also it's important to, once you get their buy-in with everything, include the department heads to the extent that they are comfortable with that. Some co-founders, I know the ones at GitHub, weren't actually comfortable with that. They wanted to be the only ones that knew the forecast, and then they would kind of outline for every other department head what they could hire and what they could not hire or spend on certain projects. So I mean, I think that's certainly the starting point, especially at smaller stage companies.
Yeah, the only other thing I would add is we do, again, weekly kind of operating committee with the leaders, and we're very transparent with data and problems, and it's sort of this open forum. It doesn't need to be pitches or, an agenda. That it's there to talk about things, issues, problems, whatever. And so that's how they use it, and that's like sort of a core tenet of how they've always used that meeting. So, for us, I think, again, people feel very vocal. The CEO is, known to be one that wants to listen to people any level. We have a feedback channel on Slack that literally everyone sees and writes whatever they want anonymously every day. So the company is extremely transparent internally, and the leaders care about the problems and they care about the culture a lot. We get great culture ratings, not so much recently, but don't believe everything you read. It's a really great place, and I think culture is a really hard thing to kind of change over time. So we don't want to lose that. So for us, they listen to employees. They really want to react to that, and they want to run the company smartly and smoothly. So.
Yeah. For us, we actually piggybacked our budgeting process with most people do OKRs. We do a balanced scorecard approach, same thing, but just strategic planning for 2020 and setting department level objectives and overall corporate objectives. So once we already knew what that guidepost was, once you empower all of your stakeholders at the department level to sort of give their inputs on a first pass or second pass, however many revolutions of a budget you want to go through, you take their considerations first. What do you need to be successful to hit that plan, and then from there, you run the consolidations. You look at what is that? Okay, I've given everybody what they want. What does that tell me? And then from there, that's when you start having those hard conversations of like, okay, well, this is not where I need it to be. ARR is not 20 million; it's 15 million. So what do we have to do to make up the delta and things of that nature? And from there, it's people are fairly willing to work with you. Especially when they all know what the guidepost is and what we're all marching towards. So it actually wasn't that difficult, believe it or not.
So one question I have as a follow-up is how much do you benchmark against competitors or market indices? Whether it's your public competitors, whether it's others in the RPA space, whether it's others in IT services. I mean, are you also in part of the planning going, look, our competitor's growing 3x, how do we get to a 4x growth in order to get that next round done at the valuation we're looking at? Or is it really just, hey, we're just benchmarking against ourselves, it's always based on last year's numbers and going from there?
So being private and relatively small, most of the benchmarks that I use for modeling purposes are coming from like a KeyBank survey in terms of SaaS metrics, and that's like our North Star. Where do you want to be, and what is deemed to be success in the SaaS world? As far as competitive set, it's a little bit more difficult. I don't have like a Cap IQ to run that kind of analysis for me, so it'd be a little bit more digging on the internet to find a company that has recently gone public with a similar that would fall into my competitive set. Probably not really relevant at a B stage, and not something that is probably worth a lot of digging. Mm-hmm. I'd say the SaaS metrics and North Star for earlier stage companies is a better approach, but understand you don't need to get there in 1 year. It's a long game, right? Some of the things that hold true is like triple, double. Yeah, that's a real thing. So if you build a model that can get you there, then that's great. That's one of many checkboxes to check off, and then start going from there.
Yeah, I concur. The other thing, we have lots of bankers and investors talking to us every day, telling us what our metrics should be. So we get a lot of information. That makes it easy. But it's good. No, it's good. And our board is, no, it's good. Our board is also super helpful. and they've got a lot of people that help us think through some of this. So that's been a lot of help for me, to be honest, with a small team. But other than that, we look at, we're spending a lot more time now on the non-SaaS metrics, like as far as comparisons, and we're focusing more on sort of what our costs for R&D and sales and marketing and G&A are as a % of sales, and making sure those benchmarks aren't out of whack. So that's sort of where we're spending a lot of time this year thinking about that for 2020. No, we're not actually, but it's because we don't want them to be out of whack.
Interpolate, yeah.
Longer being amongst accounts though, that would.
Yeah, so every time one of our comparable companies, doesn't have to be a competitor, it can just be one of the SaaS companies, has an earnings release, whether it's off calendar year end or whatnot, we send out this dashboard that summarizes all the metrics, and it could be things like R&D as a percentage of revenue, as a percentage of OpEx, what have you, gross margins, net retention, if they disclose that. It's something we definitely pay a lot of attention to, and so does our board as well as the rest of our C-suite team.
We still have more time?
We got time for one more.
One more question right over here.
This is a very quick question. Having had to explain the difference between bookings and revenue to more people in my old company than I know how to explain, how much reach out do you do beyond the C-suite down to people who are actually touching the business? Because if you do it well, I've seen amazing results. And if it's absent, I always see this gap. So I'm just curious how much you do.
Yeah, I guess it depends on who your audience is, right? If you're talking to your sales reps and say you're compensating them on bookings versus revenue, that's an audience you're really going to want to drive home what the difference is between those two. I think if it's really anybody else, you probably don't need to go into too much depth into it. But I mentioned it is something that Wall Street certainly looks at. They look at bookings, right? They look at billings, which those two are actually different. That's where that whole RPO concept comes into play. So I think that it's definitely important. And again, back to the audience and the metrics you're trying to convey and drive towards.
Yeah, I concur. The only other group I spend a lot of time explaining it to is marketing. So they like to have, information out there that they want to talk about, and so we clarify and really centralize information that goes out of the company through FP&A. So that's the only other thing that, that's the other group I train or talk to a lot about, kind of the difference between the definitions and our KPIs.
And I can endorse that UiPath's emails from your PR team have the most amount of data of any company I've ever seen. Like usually you're lucky if you get one number, and I usually get like 20 or 25 from UiPath. And I didn't even know like RPOs or whatever, anyway.
Yeah, not really something that comes up too often for us. Revenue is an output of finance and accounting versus MRR or booking is really actually booking versus ARR could be two different things as well. Don't get me started on that one. But really just have the business focus, sales focus on ARR, and let revenue as a technical accounting that has a technical accounting definition be an output from the accounting team. The one time I did see it get crazy was when I worked public for a public company, and sales comp was tied to revenue on a GAAP basis. Forget it. You're basically trying to tie it to cash, or more or less, and so you're comping salespeople on revenue, and it just became this insane explanation every single time to a salesperson on what actual revenue was. And then when you start throwing in BESP, multiple element arrangements, best estimated selling price, and discount allocations and things like that, it's impossible to actually do the bridge between revenue and what they sold. So stay away from that.
On that note, let's have a round of applause for our panel here. Thank you so much.